Hey, good morning, everyone. Welcome. It is September 19th. September 19th, and we are getting into the week, right? Deep into the week because we have a lot of news that popped off yesterday, right at the start of the week. We also have what we got cooking in the Fed tomorrow. So, a very big week overall. First and foremost, right? That has been the overlying news event that we saw most recently, right yesterday, with America's national debt topping 33 billion, or sorry, billion, $33 trillion for the first time, according to the latest figures from the Treasury Department. And the record amount of red ink and glooming fiscal milestone comes as Congress braces for another fight over federal spending, right? Unless lawmakers can agree to pass uh, a dozen appropriation bills by September 30th, or ink a short term continuing resolution to fund government, the U.S. would face the first federal shutdown since 2019. So, President Biden has proposed a series of measures that would reduce our deficit over time while investing in the economy. And this is something that we need to do going forward. This is what Janet Yellen declared. And the statistics or metric that I have looked at most often to judge our fiscal course is net interest as a share of GDP, even with the rise we have seen in interest rates that remain very reasonable level. So net interest as a share of GDP refers to the net payments that the federal government makes on its debt relation to US gross domestic product. Those interest rates total 1.86% of GDP in 2022, which fall in line with the historical average since 1960, just under 2%. But other factors are causing more alarm, and the national deficit for the first time in 11 months of the latest fiscal year was $1.5 trillion, marking a 61% increase from the same period a year ago. While total public household debt hit a record of $17 trillion in Q2, the US debt to GDP ratio reaching 120%, right? The US debt situation is out of control with no responsible body of people in the government willing to address it. This is what a lot of analysts are looking at and saying right now. So what's there to watch? There's no magic number or level where the government debt begins to hurt its economy realistically. And the U.S. has easily handed a much heavier debt load than was once thought possible, even using those conditions to remain competitive on the international stage. However, a spike in interest rates over the past year and half about has made the cost of servicing the national debt way more expensive, posing significant risks to the fiscal and economic outlook. So, extreme partisanship has also left both parties pointing fingers and kicking it further down the road and down the line. So, the GOP has cited bloated federal spending programs that passed during the Biden administration, like the Infrastructure Investment and Jobs Act, the CHIPS and Science Act, and the Inflation Reduction Act, while Democrats have referenced the trillions spent on Republican tax cuts skewed to the wealthy and the big corporations. So we'll see how that kind of shapes up. We've seen that the market is in general downside movement right now. Wouldn't necessarily call it turmoil, but we're dropping into prior day lows after seeing some kind of bullishness from yesterday's start. So we also have oil that's been pressing on inflation's upside, right? Top oil executives are voicing support for the global transition to cleaner energy, but said that crude will continue to play a major role for decades to come. In remarks at World Petroleum Congress in Calgary, ExxonMobil CEO Darren Woods and Saudi Aramco boss Amin Nasir both pushed back against the recent prediction from head of the International Energy Agency that the era of fossil fuels is ending and the demand will peak by 2030. Outlining a transition to cleaner energy to fight climate change will require continuing investment in conventional oil and gas. No matter where demand gets to, if we don't remain at some level of investment in oil and gas in the industry, you will end up running short of supply, which will lead to higher prices, said Wood. So, oil, right? Brent peaking $95 for the first time since November 2022. There's just been a lot of upside in this market, and a lot of people are looking at this saying, oh, we can't peak for too much longer, can't peak for too much longer. Again, this is something I've been saying for quite some time, right, over the past few months, so that oil is going to be and commodities are going to have a very good return over the next few quarters, realistically, and I don't really divert from that. I think there's still some more upside, but we're running towards the tail end of that before some kind of pullback. We also have the United Auto Workers, right? They're planning additional strikes against the Detroit Three if serious progress is not made. I don't remember the exact figures, but yesterday I was looking at this, and there was a lot of layoffs in these big three that were as a resulted of these strikes, right? So if there's not serious progress made in contract negotiations by noon on Friday, right? The union president, Sean Fain, warned, adding, we're not messing around. The new deadline would mark a week since the union announced the targeted strikes in factories run by GM, Ford, and Stellantis. So while a team from the White House expected to arrive in Detroit this week, Fain downplayed its role brokering the deal separately. Canada's union extended negotiations with Ford for a 24-hour period to avoid a strike after contract between the company and the union expired at midnight. So very interesting stuff. There's a lot of negative news that's piling into the markets right now, and a lot of people are expecting massive waves to the downside. Yesterday, one of the things in the U.S. market, right, in the S&P, the sellers were nowhere to be found. The sellers were getting trapped. Buyers were coming in, but I'm still under the notion that we do sell rallies, right? Overnight right now, the 08 has been sold, 45.08, putting some downside pressure in this market realistically. But overall, I still think we can attack the 44.84s, 44.72s, so on and so forth before we get into the FOMC meeting minutes, which are tomorrow, right? Tomorrow, I think that pre-event, earlier on the market open, I don't think there's going to be that much opportunity and volatility. If you're going to trade it small. Right now, I think there could be a slowdown and some chop leading into it as well. We're getting a lot of downside pressure off this market open, but remember yesterday there was a lot of traders that were getting stuck at that 44.90 on the S&P 500. So we'll see if they try to sell this, right? If they try to sell this, it's going to be from the 45.0408 as they've done overnight right now. And if they're really going to be aggressive on the sell side, they're going to want to sell from 96 to 97. But I'd be very cautious as we move into these 90s as we're coming into the Federal Reserve. There is probably going to be more of a sideways chop on the higher probability front, right? But sellers are still more active. So with that being said and all this negative news, let's see what the Fed does. Is the Fed going to come out dovish, or what are we going to get, right? So the Fed can change the course of a lot of this. Just keep that in mind as we get into that. Slower movement into the Fed is what I'm going to be looking for. So I hope everyone has an amazing day. We're going to open up our live trading room for futures in just a bit, and I hope to see you all there. Remember, check out our website for our free futures course that hinges on order flow and volume. So I'll see you guys tomorrow. Get ready for the Federal Reserve. And Thursday, we'll wrap up what the Fed had to say, what Jerome Powell had to say, and what the market movement looked like. So I'll see you guys then. Take care, chat soon, and let's open up our room.